All right. Welcome to recorded lecture for preparation of financial statements for financial reporting. Major contents, we have framework of preparation of financial statements, characteristics in presentation, preparation of statement of comprehensive income and changes in equity, as well as financial position and cash flows. When we define general purpose financial statements, or plainly we can say financial statements, these are statements intended to meet the needs of the users who are not in a position to require an entity to prepare reports tailored to their particular needs or information needs. These are usually stakeholders who are outside of the operation of the business. So when the company issued general purpose financial statements, it can be used by stakeholders or interested parties, whoever they will be. Maybe a bank, or a prospective investor, or a supplier. And when we regards to purpose of financial statements, the objective of financial statement is to provide information about the financial position, financial performance, and cash flow of an entity that is useful to a wide range of users in making economic decisions. Financial statements also show the results of the management's stewardship of the resources entrusted to it. So if you will see the statements mentioned here with regards to financial position, they're looking into the financial capability of the company. When you talk about financial performance, how they've been able to generate income, and by generating income, how much expenses they had incurred, and the inflow and outflow of cash. These are important items for several stakeholders to know, so that they will be in a good position to judge whether they put their money in the company or whether they will have to provide supplies when the company requested, or when the government had inquired about the financial status of the company. Now, as per IAS 1, this will be the complete set of financial statements. So the first one is a statement of financial position as at the end of the period. Another one is statement of profit or loss and other comprehensive income for the period. And then a statement of changes in equity for the period, statement of cash flows, and then we have to include notes, which will include explanation of accounting policies adopted by the company, plus some explanatory notes or information that will be relevant in the financial statements. Comparative information in respect of preceding period as specified in paragraphs of IAS 1.38 and 38A, and a statement of financial position as at the beginning of the preceding period when an entity applies an accounting policy retrospectively. So which means they have changed something from the financial statements which had been recorded previously. Going concern is where the company has seen to or will be operating or assumed to be operating in a foreseeable future, or to a foreseeable future. So which means in this assumption, the company will be seen as they will still be operating and no sign of they are liquidating. But if they have an intention to liquidate or cease trading, then the company will be not in a going concern status, and then they have to prepare the financial statements not in accordance with IFRS but in accordance with a different method. Accrual basis of accounting, an entity shall prepare its financial statements except for cash flow information using the accrual basis of accounting. When you talk about accrual basis of accounting, it is where we are recognizing revenue when we earned, and we are incurring loss or expenses when we consume it. Materiality and aggregation, similar items can be grouped into one, and of course there are dissimilar items that you're not supposed to aggregate, not unless they are immaterial. So that's why some financial statements, they include other assets or other liabilities. Those items included may not be material. Now, in regards to materiality, some of the discussions before, we had mentioned that the financial statements or items will be material. Account or items may be material if it is capable of influencing your decision making. Now, offsetting can be done if required or permitted by IFRS. So it's not automatic. It should be explicitly mentioned in IFRS or permitted by IFRS. Frequency of reporting, under IAS, it is required to have at least annually. Of course, if you are presenting a shorter period than a year, you have to, of course, disclose why you are choosing to report or provide a report which is not for annual year. Comparative information, an entity shall present as a minimum 2 statements of financial statements, 2 statements of profit or loss and other comprehensive income, 2 separate statements of PL or profit or loss, 2 statements of cash flows and other statements of changes in equity, and of course related notes. It is obvious that if you are starting your business or having your business just for 1 year, you are supposed to present 1 statement. But if you have 2 or more years, at the minimum you have to present 2 statements. Consistency of presentation. An entity shall retain the presentation and classification of items in the financial statements from one period to the next unless it is apparent, following a significant change in the nature of the entity's operations or a review of its financial statements, that another presentation or classification would be more appropriate, having regard to the criteria for the selection and application of accounting policies. That is under IAS 8, or an IFRS requires a change in presentation. Now, in identifying financial statements, it is important, of course, to include the name of the company and whether the financial statements presented will be for individual entity or for group or consolidated report, the date of end of the reporting period or covered by the financial statements or notes. Of course, important to present or mention the presentation currency, that is under IAS 21, and the level of rounding used in presenting amounts in the financial statement. So for example, if it is in 1,000 kina, you can mention in K000. If it is in million kina, and then K, and then million. Now, the content of statement of financial position, these are line items that may or should be included in financial position. Now, take note, of course, if you don't have, for example, intangible assets in your company, you're not supposed to put intangible assets there. So, which means the items mentioned here, or you can see in the video, will be, of course, depending on the availability that you have in your company. If you don't have investment property, you are not supposed to include that. But if you have, of course, you have to put it in a separate line item. Okay, so you can see here different line items that expected to be included in statement of financial position, not unless it is not relevant. Now, on current and non-current distinction, this is quite important because there will be certain guide or guidelines for us to remember when to classify an asset or a liability as current or non-current. Okay, so of course it is required for us to distinguish current or non-current assets or liabilities. Now, how to do that? Okay, whichever method of presentation is adopted, an entity shall disclose the amount expected to be recovered or settled after more than 12 months for each asset and liability line item that combines amount expected to be recovered or settled not more than 12 months after the reporting period and more than 12 months after the reporting period. So which means when you classify current and non-current distinction, one of the rule or guide that we can use is the months or number of years. So if it is within a year as a guide, that should be classified under current liability or current asset. Of course, if it is more than 12 months, it can be classified as current or non-current assets or liabilities. Okay, current assets. With regards to current assets, okay, an entity shall classify an asset as current when it expects to realize the asset or intends to sell or consume it in its normal operating cycle. Now, the normal operating cycle is easy to determine. It is from the starting point where you are obtaining an item to generate revenue and collect cash. So that's the first time that you're supposed to acquire the asset, and then or an item to be sold, and then afterwards when you sell it, so the date between you purchase and you sell the item or your, let us say, inventory, that is the operating cycle. Of course, you will try to see what is the normal operating cycle, okay, or try to determine at least what is the normal operating cycle. Take note, there are inventories that may need or may require more than a year to be produced. So for example is airplane. So that's one example. Or wine. Wine usually may be more than a year, okay? Because the wine, the longer it will be stored, the better for the wine, and it will be much good tasting. So which means that a normal operating cycle may exceed a year. And then another one, it holds the asset primarily for the trading or purpose of trading. So if you are buying inventory, okay, and selling it, that is current asset. And then C, it expects to realize asset within 12 months after the reporting period. So for example, receivable. So receivable, you have an asset and then you realize it. When you say realize the asset, it's actually telling that you converted it into cash within 12 months, so which means that asset will be current asset. And then D, the asset is cash or cash equivalent unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. So if the cash has restriction and you will not be able to let us say use it for more than a year, that should not be classified under current asset. But if you will be able to use it to settle liability within 12 months or for at least 12 months, so that will be classified as current asset. Okay, non-current assets, all assets that will not fall under current assets will be non-current assets. Now, current liabilities. An entity shall classify a liability as current when it expects to settle the liability in its normal operating cycle. It holds the liability primarily for the purpose of trading. The liability is due to be settled within 12 months after the reporting period, or it does not have an unconditional right to defer settlement of liability at least 12 months after the reporting period. And of course, if the liabilities are not classified under current, automatically that will be reported under non-current liabilities. Statement of profit or loss and other comprehensive income. Okay, so these are combined statements which will include profit or loss and total other comprehensive income. When you talk about profit or loss and other comprehensive income, this will include, of course, revenue, and then you will also consider finance costs, profit from associates, tax expenses, and a single amount for total discontinued operation. So aside from your revenue, such as sales, and expenses, for example, salaries expense or depreciation expense, these are items that also included in the profit or loss section. Other comprehensive income, it will have a separate section in the statement of comprehensive income. These are items that will be relevant for other comprehensive income. Okay, we have a line item or line items mentioned here. A, it says items for other comprehensive income, classified by nature and grouped into those that in accordance with other IFRS. Okay, will not be reclassified subsequently to profit or loss. Will be reclassified subsequently to profit or loss when specific conditions are met. The share of the comprehensive income of associates, joint ventures accounted for using equity method, separated into the share of items that in accordance with IFRS. And also it will include or will not be, it will include this item, will not be reclassified subsequently to profit or loss, and will be reclassified subsequently to profit or loss when specific conditions are met. Okay, just some samples of components that will be included in other comprehensive income. We have changes in revaluation and surplus, actuarial gain and losses on defined benefit plans recognized, gains and losses arising from translating the financial statements of foreign operation, gains and losses on remeasuring available for sale financial assets, and effective portion of gains and losses on hedging instrument in a cash flow hedge. Okay, we have two types of presentation of profit or loss. The first one is what we call nature of expense. Okay, and the second one is function of expense. The function of expense is the common presentation of the profit or loss statement. While nature of expense is actually trying to aggregate expenses depending on their nature. So example of this will be shown on the next slide. Okay, nature of expense, method in presenting statement of profit and loss. So you can see here, we have revenue and other income on top, and then they tried to aggregate those similar items for expenses. Example, depreciation and amortization expense. These are has a similar effect. Raw materials and consumable, again, they will have a similar effect. So this is the nature of expense, and this is that common presentation that you're familiar with. The other form, function of expense, is the one that you used to studied in other units. So the function of expense, they will try to present the expenses based on their function. So for example, distribution costs will be related to selling and distributing the item. Administrative expenses will be related to general and administrative expenses. So they're trying to put it in a separate, or they will aggregate the presentation based on their function, not based on the similarity. Okay, statement of changes in equity, that will include total comprehensive income for the period. For each component of equity, the effect of retrospective application or retrospective restatement recognized in accordance with IAS 8. So which means if you have corrected something in previous year or years. For each component of equity, a reconciliation between carrying amount at the beginning and at the end of the period. And then that will include changes resulting from profit or loss, other comprehensive income, transaction with the owners in their capacity as owners, showing separately contribution by and distribution to owners, and changes in ownership interest in subsidiaries that do not result in a loss of control. Okay, this is just a sample of statement of changes in equity. As the previous slide mentioned, you will see the reconciliation of the first year and second year. And you will see different column headings for different accounts. So we have share capital, retained earnings, reserves, revaluation, surplus. And then at the far end, that will be far right end, that will be total. Now, this is just a sample. There will be different ways or different column headings to be presented in the statement of changes in equity in other companies, but this is more likely almost the same format. Okay, statement of cash flows, this will be under or included in the presentation of financial statements. So cash flow information provides users of financial statements with the basis to assess the ability of the entity to generate cash and cash equivalents and the needs of the entity to utilize those cash flows. Under IAS 7, it sets out the requirements for presentation and disclosure of cash flow information. We have major classifications of cash flows. We have operating, investing, and financing. Now, I'll start in financing activity. Financing activity or activities are activities that result in changes in size of composition and composition of the contributed equity and borrowing of the entity. So which means long-term loans. Investing activities will include acquisition and disposal of long-term assets and other investments not included in cash equivalents. Those other investments will include investment in equity or investment in associates. And also include here investment property. Operating activities that will include revenue producing activities and other activities that are not investing or financing activities. Now, example of statement of cash flows, you will see that in the first section, it mentioned about cash flow from operating activities. The second section is cash flow from investing activities. And then the third section will be cash flow from financing activities. Again, only items that will have a cash effect will be included here. Cash inflow and outflow. Accrual should be or should not be considered here. This presentation is what we call a direct presentation. In other texts, they will present also indirect presentation, where they will start in profit and then they will add non-cash expenses and then increase and decrease in assets and liabilities, current assets and current liabilities. So if you've seen that, that is an example of indirect cash flows presentation. And that's it for the discussion for financial statement preparation. Thank you.